perceived poorly by other investors is certainly, would be a great help for me in modelling. The other element that I think would be helpful, particularly on bonds that are trading either at a discount or a premium to par, is getting more sophistication around our prepayment assumptions. To that extent, having data at a loan level on borrowers who are exiting the pool and why they're exiting the pool, and really trying to model that with some more sophistication, I think would be a benefit to me as well. So that's sort of my take on it.
Thanks, P. A quick question just in relation to one of the things I mentioned at the start with the AOFM. I think the withdrawal of the AOFM from the primary market has been universally seen as a strong signal of health for the market as a whole. I suppose just a question from an investor perspective about whether or not you believe that their remaining presence, such as it is in secondary markets, presents any issues for the, call it, the efficient functioning of the market. So I don't know, Tim, Patrick, your thoughts?
Yeah, I mean, clearly it's a positive that the market no longer needs sort of large volumes of support from a government-sponsored entity for the issuers to get the volume away. So that's clearly a positive. Obviously, there's always legislative and political risk when you're dealing with a government-sponsored entity. Changes of government, changes of bureaucrats, etc. However, I think if you look at the AFOM's approach and conduct to date, it's been very supportive of an orderly wind down, and certainly I don't get any sense that there's this overhang of volume that's about to be unleashed on the market at a moment's notice. The AOFM have been, I think, exceptionally transparent in terms of what they've been doing on the secondary market trading. Post-trade, they're disclosing the lines that they have traded, the volumes that were traded, and the levels that those lines cleared at. And the sell-down process has actually been, very orderly. I think to date they've sold in the order of a little over $1 billion from their portfolio. So, from that perspective, the conduct to date certainly allays a lot of concerns that come from having that overhang and what you could argue is a non-commercial holder. So I'll leave it there.
Okay. Pat?
Oh, look, obviously they're one of the largest holders of RMBS, so they're the 800-pound gorilla in the room, and any action they take, they know will have an impact on the market. So, hence clarity of their actions, which they've done very clearly, has so far, I think is critical for RMBS to return to a functioning, non-dislocated marketplace, with a good matching of buyers and sellers. So they've continued to be clear, and you just look at their announcements, and I think they've done a good job. So they supported the market when it was dislocated. I can't see why they wouldn't want to damage the work that they've done. Their portfolio is performing and it's amortising quite quickly. People could present an argument that perhaps it would be prudent to monetise that portfolio from a government perspective or so on and so on, but I think it's unlikely. I mean, in any market, any perceived known large seller in the marketplace is going to have an impact. So, and look, the lesson of the government selling its Telstra position down, although very different to this scenario, very different scenario altogether, it does show how a market will treat a known seller. But if they continue down the path that they're doing, I think it's a positive, and it's actually providing some liquidity in the marketplace, which is a second positive.
Thanks for that.
Yeah, look, if Joe Hockey's listening, I'm happy to show a bit on some AB notes. So
that's good to know. Just a quick question in relation to, I suppose, tenor. One of the things that has been quite notable in the broader corporate debt market in the course of the last 6 months, has been an extension in tenors that corporate issuers have been able to get. So good examples: Australia Post, probably an unusual corporate, but issuing a 10-year deal. Mirvac, Brisbane Airport, Connect East, issuing 7-year transactions and the credit tenant lease deal, which we talked about previously. There's certainly been a premium paid for tenor, but the transactions have all been very successful. You know, the RMBS market specifically has continued to stick around that 3 to 3.5 year well, albeit, you know, as was noted, the tenor is extending a little bit. There's been very little done in terms of trying to deliver tranches to the market that are longer tenor. You know, is this, you know, a master trust, you know, maybe a way of trying to achieve that, and would there be market appetite for it? Or, you know, any other comments on that topic? You know, Bruce, please.
Okay. My standard line when anybody says longer tenor, my clients are mainly domestic superannuation funds. They would view asset-backed securities as generally illiquid in nature, and the last thing they want to do is go long on an illiquid asset. So pushing tenor out on RMBS is not something that I think they would be overly keen on, not something that I'm necessarily keen on. We all know that at the end of the day, the tenor of any RMBS is really driven by the CPR speed, and to use a quote from earlier in the day, it is what it is. There's nothing you can do about that. It is going to pay off at the process. The only way to lengthen it is to effectively have some sort of revolving period. Now, as typically a lower down the credit curve investor, revolving credit periods, origination periods is something that I do not view positively. I like to be able to say, this is the pool I'm buying, this is the criteria, this is the area it was written in, this is the market it is in, and know that that's what I've got. I do not particularly want to suddenly find that I am originating loans in, use an example, southwest Sydney, when there are problems there in 3 years' time at high LVRs. It's not something I would look forward to. So, unlike some people in this room who would think that master trusts are God's gifts to the securitisation market, controversially, I do not think so. I do not see any value in them whatsoever. It also has a complication that if I buy multiple pools, so that I might be an owner of 6 or 7 pools for any one of the individual securitisers, like an Apollo thing. I might have Apollo 1, 2, 3, 4 and 5. They're all discrete and separate credit pools as far as I'm concerned. There is some overlapping credit risk from servicing and managing, but that's manageable. If we go to a master trust, then all those get combined into one pool, so the amount of exposure I would be able to take to the Apollo series would drop considerably, so that would have a real negative effect. So you might pick up some offshore guys, but you might lose some domestic guys. So to my mind, I think the tenor of an ABS is what it is, and we should leave it there, and we'll let the people work on master trusts, but I don't think Charles is in favour of them, and for once I'm firmly in agreement with Charles.
Somebody write that down. Pete, did you want to add any comments?
I don't know that there's anything more to be said.
Fair enough too.
No, I will say one thing. I think the point that Bruce started off with was liquidity, and that to me is the big problem that needs to be solved, not tenor. Liquidity in structured products, and you know, whether master trusts are the panacea, I too am not sure. I think, you know, on shorter dated receivables perhaps, more granular pools perhaps. Really the thing we need to solve is how do we get around the illiquidity of this asset class, and getting around the illiquidity introduces a whole new investor base, and that's where you can start to push things out like tenor.
Sure.
But let's remember how long it took the corporate bond market to get there.
Yep.
I'll just add in on this liquidity thing that I seeing I'm somewhat ancient. I can remember the 1852 securitisation conference where we talked about getting more liquidity in the market, and for the last 160 years we've been talking about getting more liquidity in the market. A little bit like master trusts, they're always going to be next year. I think liquidity will always be next year and will never come.
Noted. So moving on to a highly liquid sector of the market.
Liquidity that you want, didn't you?
Yes.
Non-conforming, it's continued to find, the non-conforming segment in Australia has continued to find, very good investor demand and engagement, both, in fact, both offshore and domestically. There's a spread to prime RMBS at a AAA level, but assets have continued to perform well. And that needs to be taken with a grain of salt in terms of thinking about, benchmarks like SPIN, which are potentially statistically a little bit vulnerable. In an interest rate cycle where we're probably getting towards the bottom, if we're not there already, do we expect to see that trend of, good performance in non-conforming continue, and will there be, I guess, product innovation, maybe more on the asset side, I suppose, making, a return? Patrick, your thoughts?
Look, the non-conforming sector, which is obviously really only a very small portion of the RMBS market, as we all know, we believe, offers still considerable value, and we are very happy to continue to invest into this sector. I mean, if you look at the historical performance of non-conform deals since the GFC, and actually ones that were originated pre the GFC, at least not from an affiliate of ours, Pepper, arrears, defaults and loss rates have been extremely compelling from an investment perspective. There's no doubt that there were some deals that were horrific, and then performance was very poor, and when Bruce talked about liquidity, there was no liquidity, there was no bid in these assets, and certainly in down markets I think that scenario will remain, and you need to price for that liquidity. However, some of the transactions we hold in the portfolio have losses at under 10 basis points, and they're getting close to their call date. These spreads that we're buying them at are pricing default scenarios, numerous multiples of actual losses. So I think it's a very I think it's a cheap market, would be the best way of saying it. We only buy deals that the issuer has a proven core record and its servicing and loss profile is well rated and understood. Of course, there was a number of deals I mentioned and portfolios of issuers that did not survive the GFC. Obviously, from that moment and where people have bought those assets, they've performed extremely well. We don't purchase those deals. We feel we get paid sufficiently well for issuers in the non-conform market who do core their deals, that we don't need to move down to that part of the credit curve and its perceived liquidity and its actual liquidity. Having said that, we know that a number of investors have produced tremendous returns by investing in those deals. So when we talk about nimble investment, I think some of those deals have been attractive for certain investors. The tightening of the consumer credit laws in 2009 and I guess the barriers to entry in this space for non-bank originators, and I do think there are barriers to entry for people to get warehouse lines these days, to have a strong servicing platform.